Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And the question is, what's up over 260% over the past 2 years? Yeah, we're talking about our old friend Meta, and we have new numbers for it. So let's get right to it. And remember, folks, if you want to live on this beach like Jimmy Buffett used to live, then you've got to learn how to invest even better than Warren Buffett does now. And let's see what Meta does, as if we didn't know. It operates the world's leading social network service through its Facebook website. Now, what's second? Yeah, YouTube. And now the company's web-based tools allow users to connect and communicate with each other. And they have about 327 billion, that's billion, folks, with a B, monthly active users as of 6/30 of 2024, almost 6 months ago. It also owns Instagram, WhatsApp, and Messenger, and it generates substantially all revenue from selling advertising placements to marketers, and has about 67,000 full-time employees, which is about 5,000 less than it did last year. So it's trim and ready to go. And boy, that's exactly what it's been doing, folks. Now let's look at the thumbnail sketch of Meta, and we are looking at the clean surplus return on equity. And folks, remember, the clean surplus return on equity down here is totally different than the traditional accounting return on equity. So don't even try to compare them. They're usually over 100% difference between one and the other. And the clean surplus return on equity is much more stable, much more consistent, and it works. So we look at blue, which is the average stock in our database, and the green is Meta. So we can see that Meta has almost a doubling of the return on equity. And think of your bank account. Would you rather put money in the bank that's giving you a 13.5% interest rate per year, or growing at 13.5% per year, or one that's growing at 23.8% per year? Yeah, and that's how you look at the clean surplus ROE. It gives you this kind of information. Now we look at net income. Now net income is the clean surplus earnings, because you take the traditional accounting earnings, you subtract non-recurring items and future liabilities, and you come up with a different number than the traditional accounting earnings. Yeah, and you can see double again here, that Meta has double the average stock out there. Remember, what are we trying to do here? We're trying to outperform the S&P 500 average, because the Morningstar report from 2002 said that, or reported that, over any 10-year rolling period, 96% of professional money managers who run their publicly traded mutual fund companies cannot outperform the S&P 500. So we want to fill our portfolio with stocks that do outperform the S&P 500, and Meta is one of them. Now revenue is very important, because if you're not bringing in the revenue, you cannot bring any numbers to the bottom line, which is your net income over here. So revenue, yeah, we're looking at 3 times the revenue for Meta than is coming in the average stock. So this is the number to keep your eye on. And the net income says, is it bringing it to the bottom line efficiently? And yes, Meta certainly is. Now, let's look at some other numbers that I want to show you. These numbers over here, the net income, they have been revised upward, because for 2025, this number has been revised just recently up from $22 up to $24. And for 2024, this year, it's up from $19.50. So Meta is outperforming the high expectations, and boy, it gives us that nice clean surplus return on equity. And to get into our growth portfolio, we want to see above 20% for the stocks that we put in that portfolio. And I have this $1.29, which we're going to talk about in a further slide, and it will give us an indication of what's going on with this stock, and you're going to love it. Retention rate, 97% on average over 5 years, which means it's taken just about all the money it's making, putting it back into itself in order to grow. Now, the net income growth rate and the revenue growth rate, as we showed, are way above the average stocks. And look at some of these numbers down here, folks. So we look at 2024, great numbers, and here's that net income growth number, and look at the great income number in 2023. And so, yeah, we've got great averages in here, folks, and that's what we want to see. Years to pay debt. This is Buffett's rule of thumb. He says if a company takes all the money it's making and uses it to pay off its debt, how many years will it take to pay off debt? And his rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. Meta, 3 months or so. In other words, you snap your fingers and it could pay off its debt. And recent dividend, we don't like stocks with dividends, or very, very small dividends anyway, because we want to see most of the money going back into the company in order to grow, and not back to the shareholders in the form of dividends, which is double taxation. Remember, the company is taxed on this number, and then when you receive the dividend, you're taxed on it. So you don't want to see dividends in a growth portfolio. You want to see this retention rate. In other words, all the money that is coming into it, you want to see it go back into itself in order to grow. Meta is doing just that. Let us look at the 1 year price. Black line is the S&P 500. Over 1 year, up 70%, while the S&P 500 is up about 24% right now. But let's look at something else here. Over 5 years, this is what we're talking about. Again, black line is the S&P 500, up about 88%, with Meta up about 190%. Over here, but this is what we wanted to show you from here. Remember, 2022 was a bad year in here, and this is all 2022. So the market was down 19.6%. The NASDAQ was down 34%. And we see that Meta took a big, big dive. But when you measure from here up to here, now you're talking about 260% or so. Very, very nice, Meta. Thank you, because, yeah, it's been in our portfolio for a long time, folks. We like these kind of returns. Again, we want stocks that outperform the S&P 500, and Meta is doing its job. Now, let's go back to this $1.29 that this stock made in 2015. So it's making, or made $1.29 back in 2015, and for next year it's expected, for 2025, expected to make $24 a share. That's about a 20 times change to the upside from $1.29 up to $24 over this 10 years. So let's look at where this stock was 10 years ago. It was a little under $100 a share. See right in here? Little under $100 a share. So you multiply that by 20 times, and we can see we're talking about a stock that really should be trading way up here somewhere. Yeah, 20 times $100, or even 20 times $80 if we're looking at it close. Or we're looking at the price this stock should be trading at way up here sometime. So that's how we look to see if a stock is priced up to its potential, by looking at the past and saying, okay, what happened back here? What was the price and what was it making? If it was fairly priced back here, it should be fairly priced one of these days soon, and that means that we should see a stock price way up here. So we think Meta still has a long, long way to go, folks. So yeah, it's been a tough week, folks, going into the holidays, and we had the market do a hissy fit fall on Wednesday, and yeah, we didn't like what we saw, but that's part of the game, because the Federal Reserve indicated it would not raise or lower interest rates 4 times, which is what the market expected in 2025, but probably around 2 times. Of course, they're always saying that they're data dependent, so we'll see what happens. But the market just wasn't expecting that, so this fall that we saw this past week, I don't think is very sustainable at all. Once the market settles in and says, okay, a little slower growth than we expected because interest rates won't come down as fast as we thought. So what is the market truly valued at? And over the next couple of days, it'll tell us, and it'll settle in, and we'll go from there. So, folks, this might be a very nice buying opportunity in a couple of days or so. So, folks, again, tough week. Holiday coming up, so that's always good for the market. And we are getting ready for January. Our new portfolios are coming out in just a couple of days. days. So, folks, you go out, you clear your heads, get ready for the holidays. Forget about the market. It already fell off the cliff that it was going to fall off, and it wasn't a very big cliff. It was just a nasty one-day sell-off, and let the market settle in. And if you have any extra money, I know we're going in because we made some money on the downside using put options and inverse ETF options. And so we have extra money now, almost about 10%. And so we're going to be buying stocks over the next couple of days. All right, folks, you take it easy. You have a safe weekend, and we'll see you back here in a couple of days. Happy holidays, everybody.